Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. It's a good idea to sometimes stop and take stock of what your equity portfolio is doing and make adjustments based on how you read various moving parts. As things stand, the last 10 days have been good for the Indian equity markets and we've moved up. In fact, you've had gains in 9 out of 10 sessions for the benchmark Nifty 50, and that means that your equity portfolios will be looking better than they were even last month. But what's the path ahead looking like? What are the factors that could affect equity markets? And we'll talk about this with Trideep Bhattacharya, the CIO of equities at Edelweiss AMC. Trideep, thanks as always for taking the time. And I like to call CIOs, fund managers, people who manage my viewers' money so that they get a sense of what you're thinking and what you're paying attention to. So let me ask you a broad-based question at the start. You have global scenario that is still unpredictable. As we speak, and as we're speaking about this right now, you have that 50% tariff that continues to exist. But on the domestic side, you have several reforms that have already taken place, the last of which is the GST, the rollout of which takes place next week. How are you reading all of this and what do you anticipate for the equity markets?
First, thanks for having me on your ever-popular show. I would say that the mood point which India has been grappling with for close to a year and a half now is the earnings downgrade cycle. This started when India went into elections around about the middle of last year, continued all the way through last year overall, and through some parts of this year, we've seen good policy announcements come through, but even in the last quarter result season, earnings were downgraded rather than upgraded. And this earnings downgrade cycle is what kind of keeping markets in check, sometimes more volatile than others, but more generally, I would say in check over the last 6-7 months. And of course, there are macro headlines, which, as you pointed out. And I think for us to understand the way forward, we need to understand the way forward with regards to earnings. And in that context, I would say that the recent measures that have been announced by government on account of GST reforms, if you put that on top of the fact that inflation has been coming off, crude oil has been coming off, and overall the tax breaks that were announced early in the year, makes me feel that there is a good chance that we will start to see the end of this earnings downgrade cycle, from Q3 FY26 onwards, which is 1 quarter ahead. Not the immediate quarter, but 1 quarter ahead. And given that's the case, that's the view, I think in the next quarter, you could see management commentary turn around a little more positively than what it has been in the past. What you see very recently in the markets is a little appreciation of that undertone. And of course, the fact that the macro volatility on account of Indo-US relations seem to be a bit on the mend. So net-net, we are standing at a crossroads of earnings downgrade cycle for India Inc. And next couple of months are worth watching out for in that context. If we come out triumphant, we have a fairly strong rope ahead, but that needs to happen though.
Okay. So I recall that we had a conversation, and I quite enjoyed that conversation, Trideep, after the budget, when we spoke about the income tax reform that took place and the fact that the new tax regime, which I'm sure most of my viewers have gravitated towards because it has so many benefits, would lead to a consumption boom. I think we're yet to see that take place, and I think you would agree, and that leads into what you were saying earlier as well. We're yet to see the benefits accrue to companies. What are the spaces that you think will see a leg up on account of that coming through? You have the 8th Pay Commission, you have the GST reform, and as a result of which a lot of commodities getting cheaper, you have a positive monsoon, so several tailwinds coming together. Where does the earnings uptick first start taking place?
Sure, I think it's a great question. So I think broadly, consumption is the first starting point. And then if you double click on that, consumption could be subdivided into 3 major components. One is the luxury consumption, second is the rural consumption, third is the mass consumption. So within consumption, I would say that the first pickup would probably come in luxury and rural, the two ends of the consumption, so to speak. And in our portfolios, we are kind of positioned accordingly. The last one to kick into gear would be mass consumption. This is where consumption has been on the leverage front, and hence, as the tax breaks come into effect, which have been in the last few months, as the GST cuts lead to higher discretionary income, you will see this segment also coming about, but with a bit of inertia, with a bit of lag. So luxury, followed by rural, followed by mass consumption would be the sequence in which within consumption, I would see things improve. The other cut that I would provide is between discretionary and staples. So I think big ticket discretionary areas like, for example, autos is where I would think that particularly the GST related reform would have a meaningful impact. Mass consumption, maybe a little bit, but not on a sustainable basis. The big impact could be in the form of autos, in the form of other discretionary areas like hotels, etc.
Got it. Let's drill down a little bit into your portfolio strategy as things stand right now. And I also appreciate, Trideep, that you have perhaps one of the largest exposures at this point for active fund management into overseas equity, right? So how are you looking at allocating right now? And if you can also, maybe we can start with how your hybrid strategy is panning out, because that would kind of give you a sense, or my viewers a sense, of whether you're positioning aggressively in equity or otherwise.
Sure. I think our overarching view on equities is that markets are at the moment broadly fair value. And hence, buy on declines is a good way to sort of, participate in the upcoming rally once the earnings upgrades start to come through. As I said, we expect earnings to come through from Q3 onwards, so there could be a few months where we will have to deal with the volatility along with the macro volatility that we are seeing, and hence a bit of a fair value market. So we don't expect markets to run away, but at the same time, we are positive on markets medium term, i.e., 12 to 24 months, because we think that we are at the cusp of start of earnings upgrade cycle, so to speak. So keeping that in mind, I think our equity and debt percentage in our hybrid strategies are quite balanced to that effect, and particularly on the between the equity and debt, and within equity, I would reckon that our strategy is a little bit more of well spread out across large, mid, and small, rather than trying to pick one of the extremes, which is large or which is small. So we are at the moment preferring a middle of the road approach because we think that the markets are reasonably valued. But at the same time, there is an earnings upgrade cycle which kind of is waiting to pan out. So that's where we are in our view.
So I do know that you use arbitrage quite effectively in your hybrid portfolios as a combination with equity. So if you take that into account as well, are you lower in equity than you have been in past months and years, or as you said, are you more or less balanced in your approach right now?
Balance is the right way to think about it overall.
Okay. And when you drill down into equity, you said that you have a pretty broad spread between the market capitalizations, but talk about sectors. Yeah, you've already spoken about what you think is going to do well, but what are you underweight on, what are you overweight on in your most blank canvas fund? So if you're talking about the ones that span market capitalizations.
Sure. So the first, to add on to consumption, of course, is the overarching theme that all of us are, waiting to see through in the second half of this year. But apart from consumption, we are also positive on a subcomponent of financials, which is NBFCs. We think that as a combination of where valuations are, where growth could rebound to, and beneficiaries of rate cuts, all these three put together makes us feel an overweight in this segment as a second area of overweight in our portfolios. The third area that I would point to are select focus areas within government capex, which could be areas like defense, power transmission, and to a certain extent, real estate. These overweights are funded by the commodity-related sectors in our portfolios, which could be oil and gas, metals and mining. We think that while we could see tactical rallies in these sectors, a structural tailwind is probably missing, and we would rather be in users of these commodities who generate output rather than the commodity makers as well. The final bit that I would say on positioning is one anti-consensus bet that we have had over the last couple of months has been basically neutral to marginally overweight IT services. While the macro headlines, the news flow are quite negative, we think valuations are reasonable in that segment, and any resolution on the US India conflict could actually lead to better days ahead for the sector. So that would be in a nutshell our sector positioning, including overweights and underweights.
Got it. And that's pretty comprehensive. Trideep, you mentioned that you don't expect runaway returns from this point. And I think that has been the case, and that has been echoed by quite a few of your peers over the last several months. But you also said that you anticipate that starting Q3, you might see a change in the earnings trajectory. And as we all know, the markets tend to discount this early. And so what I'm trying to get at is what your own assumption is for earnings growth overall for FY26, that is the current financial year. It's been anemic in the run-up to today. Do you anticipate nominal GDP growth kind of earnings growth, or do you anticipate that with all the tailwinds that we discussed, it might be better than that? And what is the expectation that you think investors should have for the current financial year and heading into next year?
Great question, and a good nuance point that you spotted. So if I put a bit of background to this, in FY25, the year that went by, we started off with forecasting, or not we, as in the market started off with forecasting close to 15% or somewhere between 13 to 15% earnings growth for broader markets, Nifty 50 or thereabouts. By the time we came to an end, we cut almost about 10 to 12% of this. So, as you rightly said, hence in FY25, we are sitting on a base which is fairly benign of close to flat earnings. So the asking rate is not on the high is the first point. On that base, while policies have been a little kind of, lethargic, particularly last fiscal year, they have made a comeback along with the plethora of reforms that we talked about so far. All of this makes us feel that in FY26, we would see certainly a higher growth rate than what we have seen in FY25. And my sense is that this would be in the range of 8 to 12% by the time we come to the end of FY26. The exact variant of where this will land up in that 4% gap really lies on how quickly we resolve the Indo-US situation, because it will have a bearing on sentiment and spending patterns, and also with regards to rate cuts and how they pan out to be. But broadly speaking, that's how we would expect to be. But from your viewer standpoint, the main understanding that we should have is once we cross over this quiescent point of moving from earnings downgrade cycle to that of an earnings upgrade cycle, the next 12 to 15 months would have a clear runway in terms of sectors and better earnings momentum, so to speak. That's when we think that better equity returns might actually stand to follow, as long as the global situation remains a little constructive.
Yeah, well put. Trideep, thanks so much, as always, for taking the time. Pleasure speaking with you.
Likewise.